Scott, thank you for being with us this morning. Your mid-cap growth portfolio, what are your current weightings and sectors?
Well, current weightings, I mean, we are a growth portfolio, so we're focused on the growth areas of the economy, particularly technology is probably a quarter of the fund, healthcare another 10–12%. We do have a little overweighting in energy right now, but those are the big areas of focus right now.
It's no surprise that IT is one of the bigger parts of the fund. What are your favorite stocks in that and why?
Well, we're diversified within that group because we think there are some attractive areas. A couple of our bigger holdings, one Intuit, I think everyone's familiar with TurboTax, but you know, Microsoft is getting out of Microsoft Money, which should be a real good upside for QuickBooks for Intuit, so that's one example. Another company we like is American Tower. Again, there's the cellular area, a lot of 3G requirements, a lot more data required, which means there's a lot more equipment going up on towers. And American Tower is kind of like a hotel company or a real estate company. You know, the more things that get on the tower, the better for them, because every piece of equipment you put up or every new operator is more revenue for them. So that's another example.
Now, are there any ideas in the fund that are contrarian to popular views on the street?
In tech, I would say that, you know, one are not significant areas within technology. Within the portfolio as a whole, I think we probably have a little contrarian view within the energy area. I mean, we are fairly bullish on energy. It's been a good area lately. I think the other area that we're probably contrary was we are starting to get pretty excited about the consumer area. I think you know, people are concerned. Unemployment's still 10%. But going into next year, there's a lot of company management teams I'm talking to who have taken away 401k, bonuses, you name it, the last few years. Well, that's going to come back. So I think there's going to be, even though we won't have a lot of new people going into the workforce, the current people in the workforce are going to get a lot more money starting next year.
So are you talking about consumer discretionary or staples or what sort
Primarily the discretionary area. I think as we go into next year, as I mentioned, several of the company management teams have, you know, either stopped putting money into 401ks for people a year ago. They stopped accruing bonus plans. There were 10% salary cuts. Well, a lot of that's going to come back in. So there'll be some consumers that feel better about themselves, and I think that'll tick up consumer confidence for those particular individuals. They'll be able to spend some more money. So
I think you are a bit underweight healthcare. Has reform talk in Washington impacted how you think about that sector?
Yeah, it certainly has. You know, particularly the managed care area. You know, you just don't know what's going to happen, how much the government is going to take control or manage insurance rates. So that's an area we've been very concerned in. And in mid-cap, it's a bigger part of the universe we select from. So we've been underweight that group.
So given the run-up in the market, obviously I believe that the mid-cap names have performed the larger cap names. What is the biggest risk to investors at current levels? I mean, is a rebound already factored in? What are we going to be seeing going into 2010 here? Well,
I think if you rewind back to when the meltdown occurred a year ago, I think the mid-cap stocks took it on the chin maybe more than others, and they were the worst performing asset class in the downturn last year. And one of the reasons were I think these were fairly heavily hedge fund held as a percentage versus small or large hedge funds had a pretty big chunk of the mid-cap. And so as a lot of outflows occurred from those funds, those stocks got punished the most. And I think into this year, the valuations were much more attractive, so I think you've got the biggest rebound. I think our mid-cap fund's up near 40%, the benchmark's up near 40%, so huge rebound in that group. Going forward, the biggest risk is valuation and where expectations are. I think right now, earnings growth should be good as you go into early next year.
So the comps are easier.
Yep, the comps are easier. The issue is going to be everyone's going to be worried about when is the Fed going to start to take money out of the system, you know, reduce liquidity, and that's going to be bad for PE valuation. So you kind of got E's going up. The issue is how much is the market going to pay for those E's. So PEs could be coming down next year, so you're going to have that struggle between earnings growth and contracting valuations, and we think that's the risk for next year.
Gotcha. Thanks, Scott.
Sure.